Your portfolio can be up, your account balance can look bigger, and you can still be losing ground. The question is not just how many dollars you have. The real question is what those dollars can still buy. When people talk about investment returns, they usually mean nominal returns. That is, the return you see on the statement. If your account grows from $10,000 to $11,000, your nominal return is 10%. Real return asks a different question. After prices have gone up, how much extra purchasing power do you actually have? It adjusts your return for inflation, so you can see whether you are truly wealthier in practical life, not just richer on paper. This difference matters because our brains naturally focus on the number of dollars. Bigger numbers feel like progress. But money is useful because it buys housing, food, energy, travel, healthcare, time, and choices. If those things get more expensive, the same dollar amount does less work. Inflation means the general price level is rising over time. It does not mean every single item rises at the same speed. Some prices jump, some stay flat, and some fall. But when the overall cost of living rises, each dollar buys a little less than before. Imagine you earn a 6% investment return in 1 year. That sounds good. But if prices rise 4% during that same year, your real return is only about 2%. You have more dollars, but only a little more buying power. For everyday thinking, a useful shortcut is simple. Real return is roughly nominal return minus inflation. If your nominal return is 8% and inflation is 3%, your real return is roughly 5%. This shortcut is close when the numbers are modest. There is also a more precise way to calculate it. You compare the growth of your money with the growth of prices. If your money grows by 8% and prices grow by 3%, your real return is about 4.9%, not exactly 5. The precise version matters because percentages stack on top of changing bases. A 3% price increase is not subtracted from the same thing as an 8% account increase. For most beginner decisions, the shortcut is fine. For long time periods, precision matters more. Purchasing power is the heart of this topic. If $10 used to buy lunch, and later the same lunch costs $12, your $10 lost purchasing power. The number printed on the bill did not change. The amount of life it buys changed. Investors care about real returns because goals are paid for in future prices. Retirement, college, rent, medical bills, and groceries will not be priced in yesterday's dollars. A portfolio goal that ignores inflation can look comfortable on a spreadsheet and feel tight in real life. If this kind of clear money explanation helps you think more calmly about investing, consider subscribing. The goal here is not hype. It is to make financial concepts feel understandable before they affect your real decisions. Real returns are not only for portfolios. The same idea applies to wages. If your salary rises 3%, but your cost of living rises 5%, your paycheck is bigger in dollars, yet your lifestyle may feel squeezed. Nominal income rose, real income fell. Now think about cash savings. If a savings account pays 2%, that is the nominal interest rate. If inflation is also 2%, your real return is close to zero before taxes. The account balance grows, but the spending power may barely move. This does not mean cash is bad. Cash can be useful for emergencies, near-term bills, and peace of mind. But there are two types of safety. One is safety from market loss. The other is safety from losing purchasing power over time. Riskier assets are often discussed because they may offer a chance of real growth over long periods. But chance is the key word. Stocks, real estate, bonds, and businesses can all have good or bad periods. Real returns are never guaranteed just because an asset has risk. Bonds can be especially sensitive to inflation. A bond promises payments in dollars. If future dollars buy less, the real value of those payments is lower. That is why investors often look at both the stated yield and what inflation might do to that yield. This is how a portfolio can be up while your future lifestyle is not. If your account rises 4%, but the things you plan to buy rise 6%, you are behind in real terms. The statement looks positive, but the goal moved farther away. Official inflation numbers are averages. Your personal inflation can be different. A renter, a homeowner, a student, a parent, and a retiree may each feel different price changes. Your real return matters most against the basket of things you actually buy. Over 1 year, inflation can feel like noise. Over 20 or 30 years, it can reshape the meaning of a dollar. Even steady, moderate inflation compounds. That is why long-term planning needs real returns, not just impressive nominal totals. Compounding is usually presented as your friend, and it can be. Returns can compound. Dividends can compound. Interest can compound. But inflation compounds too. Each year of higher prices becomes the new base for the next year's price increases. Suppose someone says they doubled their money over many years. That sounds impressive, but the real question is, what happened to prices during those same years? Doubling your dollars is very different if the cost of living barely changed versus if prices also nearly doubled. Inflation is not the only force between your portfolio return and your lifestyle. Taxes can also reduce what you keep. A taxable investment can show a nominal gain, then owe tax on part of that gain, leaving a smaller after-tax return. In many tax systems, capital gains are commonly calculated using the difference between what you paid and what you sold for in actual dollars. That can mean tax is based on a nominal gain, even when part of that gain simply reflects inflation. Imagine you buy an asset for $100 and later sell it for $120. On paper, the gain is $20. But if prices also rose a lot during that period, the real gain may be much smaller before tax is even considered. That is why investors sometimes think in 3 layers. First is the nominal return. Second is the after-tax return. Third is the after-tax real return. The last one is closest to the question that matters most, which is how much future spending power remains. Fees can be another quiet drag. A fund fee, advisory fee, trading cost, or product charge may look small as a percentage, but it reduces the return before you compare it with inflation. A small annual gap can become meaningful when repeated for many years. The lesson is not to chase the highest nominal return at any cost. Higher possible returns usually come with higher uncertainty. A smart plan balances expected return, risk, time horizon, taxes, fees, and the reason the money is invested in the first place. Money needed soon has a different job than money needed decades from now. Short-term money often needs stability, even if the real return is low. Long-term money usually needs a better chance of outpacing inflation, even though the path may be bumpier. When planning, it can help to separate nominal targets from real targets. If you need your spending power to grow, you need returns above inflation after costs. If you only focus on the account balance, you may celebrate growth that does not actually improve your options. Inflation-adjusted thinking makes comparisons cleaner. A salary from 10 years ago, a home price from the past, or an old investment result may sound cheap or expensive in nominal dollars. Adjusting for inflation helps you compare values across time more honestly. One common mistake is treating inflation as someone else's problem. If your goal is far away, inflation is already part of that goal. Future rent, future groceries, future insurance, and future travel are not separate from investing. They are the reason real returns matter. Another mistake is assuming one inflation number tells the whole story. The economy has an average, but your life has details. If your biggest expenses rise faster than the average, your required real return may be higher than a simple headline number suggests. A third mistake is ignoring sequence. If high inflation arrives at the same time as weak investment returns, the real hit can feel larger. This matters especially for retirees or anyone withdrawing money because losses and withdrawals can reduce the base that has to recover. A practical way to think about any return is to ask 4 questions. What did I earn in nominal terms? What did inflation do? What did taxes and fees take? And after all of that, did my purchasing power move closer to my goal? Nominal returns tell you how your dollars changed. Real returns tell you how your life choices changed. Both numbers can be useful, but they answer different questions. If you want to build wealth that actually supports your future, always bring purchasing power into the conversation. What part of inflation-adjusted investing still feels confusing? Leave a question in the comments or suggest the next money topic you want explained in plain English. Your question might become the starting point for a future video.